Welcome, students. Today we are going to learn Unit 6 Entrepreneurship, Business, Finance, and Arithmetic, Grade 11th. As you can see on your screen, business arithmetic includes lot many calculations, plus, minus, and record keeping of entire business and financial transactions. Few books are to be maintained by a businessman to have a smooth functioning and to keep a correct amount of cash records. Few definitions and few terminologies that we are going to learn in related to this chapter. They are as follows. First is cash register. All the cash transactions are recorded in a book called cash book that you have already learned in accountancy. This cash book is also known as cash register. In accounting language, the cash book is a book of original entry. That means when the transaction, any financial transaction happens, it is first entered in the cash book. The term entry means making a note of the cash received or given. As we all know, the importance of cash or money in the business is similar to the blood in human body or in any living being. In business, all the transactions are made by paying or receiving money or equivalent of cash such as checks. Sometimes when the business have trust in people, cash does not cross hands immediately, but instead they are given, and that situation or arrangement is termed as loan or credit, with an understanding that the money will be paid at some later date and the loan will be considered as paid in a due course of time. Here you can see the specimen of cash register. This is in the EPR software, that is Tally software. The descriptions you can see, that is for what reason the money is either coming in the business or going out from the business, and the final balances after these events happen are mentioned and derived from this cash register. Now, cash inflows and cash outflows are maintained in the cash register. Inflow is a receipt of money in the business. That means the money is coming in the business. Main and very primary inflow of any business is sales. The primary activity of any business is selling, and by sales, the money is always inflowing in the business. Sales receipt, loan received, owner's equity, government subsidy, sale of cash, rent received, claim received, and interest earned. These are the events which shows cash inflows in the business. Cash outflow is a payment made by the business. That means these are the ways or means which will make the money flow out of the firm. Purchases of assets are the primary and important outflows of the business. Procuring the things or the resources which help the business to happen are also considered as outflow of the business. Purchase of raw material, plant and machinery, building, land, computers, tools, interior decorations, furniture, and fixtures. Apart from this, there are other resources or so outflow is a payment that is made out of the business. The money that is given out from the business to procure the resources is outflow. Next important terms that we are going to learn is about unit of sale, unit of cost, and unit price. Unit of sale is defined as a measure of what products are sold. That means on what price the products are sold. Unit cost is the amount of money that is implied or incurred by an entrepreneur to produce, store, sell, and distribute the products or services. Unit price is the price at which the one unit of sale is sold. So, unit of sale and unit of price are not a same thing. So unit of sale is a measure. Like if you talk about any product, it is in numbers or quantity. So it is unit of sale. And unit of price is a value for money that product or service can earn for an entrepreneur. Gross profit. The difference of price and cost is gross profit. Price is always more than the cost, and that refers to profit. Excess of unit price over unit cost is known as the unit gross profit or unit gross margin. This represents the business profit from selling a product or providing service before deducting fixed expenses such as salaries, rent, and other expenses. Unit cost includes fixed as well as variable cost. Is also known as cost of goods sold. Cost, expense, and expenditure. Expenses. What is an expense? An expense is a value of the resource that was used up or was necessary in order to earn the revenue during the time period. Expenditure is a payment or disbursement. The expenditure may be for the purchase of an asset like buying machinery, paying dues for items bought on credit, a distribution to the owners, buying raw materials, paying for advertising, salaries, etc. In short, expense and expenditure are the most important implication or inputs that will give the best output in the form of gross and net profit. Cost. Now, costs have basically four categories. First is startup cost. It is a cost which is incurred initially by a business when a business is started. At the time of starting of business, for inauguration, for primary assets, and for procurement of various license, certain amount of money is incurred, and that is called startup cost. Operational cost. These costs are for carrying out the day-to-day operations of business or enterprise. To run the things or to implement the planning in a very smooth and efficient manner, certain costs are to be bared. For running the business in a very smooth manner, are to be operations are to be carried on, and for these operations operational costs are incurred. Fixed costs are the ones which has to incur by virtue of the fact that one has started a business and are operating it. That means at the time of starting up of business, certain big amounts are invested which will give benefits in coming years. Variable costs are those which vary as the total cost to the organization. It depends on the number of goods which are produced and sold. Unlike fixed cost, variable cost always depends on the production of goods or services, while fixed cost has to be made whether there is production or not. Income statement. Now, for business arithmetic, after recording the accuracy of the financial transactions and in relevance with the actual cash in hand has to be compared. For that comparison, certain basic statements are prepared. An income statement is a statement that gives a true and fair value of profit earned by that business. Income statement determines that what and how the profit is earned. The reason for any business is to earn profit. The objective or the main goal is profit. Profit is considered as a financial benefit that is realized when the amount of revenue is gained from a business activity and the gained revenue exceeds the expenses, costs, taxes need to sustain the activity. In short, when the incomes are more in comparison to the expenditures, costs, and taxes, the remaining or the residual amount is considered as profit. This income statement enables us to determine the profit over a period of time, mostly of one financial year. It is, it is also known as profit and loss statement. In some institute, it is also known as statement of operations or statement of affairs. This is the proforma, the example. Here, sales, it is the revenue. From revenue, various expenses like variable cost is deducted. From there, gross profit is earned. Then, out of that, fixed costs are deducted, and you will derive a profit before tax. From this profit, the taxation is deducted, and net on hand profit is determined on the basis of this statement. Profit is equals to total sales revenue minus total sales expenses. Profit before tax is gross profit minus fixed expenses. And profit after tax is net profit after deducting the taxes and interest on loans. Next statement, very important, is cash flow and cash flow projection. Cash flow refers to the movement of money in and out of a business during a specific period of time, while cash flow projection, it shows how cash is expected to flow in and out of your business. Cash flow projection is estimation, while cash flow is the summary of all the inflows and outflows of the firm. The pro forma for cash flow projection month wise is here on your screen. Inflow and outflows are listed and total differences is derived. The difference of inflow and outflow is the balance that remains in hand with an entrepreneur at the end of a particular period of time. Break even point. Break even point is a neutral point where there is no profit or no loss. Break even point is expressed as quantity of a period. It may be in terms of days, weeks, and months. The formula for calculating break even volume, that means how much a businessman needs to produce to bring out a break even point, that is fixed cost over gross margin. In the given formula, it is break even volume per month, so fixed cost per month is taken into consideration. Gestation period. Gestation period is a period of not making any profit. When any business it's started and it takes almost 3 to 4 years to cover up all the costs which are incurred to start and set up the business. The period in which the earnings or profits are covering up the costs that are incurred for investments and for setups, that period is considered as gestation period. Last and important topic is taxes. Why do government levy taxes? Governments levy taxes and collect taxes so as to spend it for social welfare in the form of public expenditure like laying roads, providing social service, paying government workers, and providing other social amenities. Since business is also a part of social activity, an entrepreneur is also bound and liable to pay taxes. We'll see what are the main types of taxes. Basically, there are two types of taxes: direct tax and indirect tax. Direct tax are the taxes paid directly by the person to the government. The entrepreneur may be a collection agent. Sometimes the customers, when they buy any product, they pay tax to an entrepreneur. An entrepreneur plays a role of collecting agent, and that amount of tax is paid to the government by an entrepreneur. Indirect tax, it is an amount paid indirectly by the person to the government, like while purchasing a product. Taking the same example, for customers, the amount of tax that they have paid on purchase, that tax is indirect tax because customers are not directly paying that tax amount to the government, while an entrepreneur who is collecting all the taxes from the customer, he is paying. So in that case, the tax which is collected by entrepreneur and paid to the government, and for an entrepreneur it is a direct tax, but for a customer it is indirect tax. Types of taxes: income tax. It is an annual tax on income or a profit of an individual. The rates and other details vary from person to person based on his earning activities like sole trader, sole proprietor, partnership, or corporation. Sometimes the method of income statement is also one of the reasons for varying in the income tax. Income tax is different for different individual depending on their economic activity, whether a person is a businessman, a professional, or the person is employed somewhere. Next is corporation tax. Corporation tax, the tax live on the income of the domestic company or a foreign company. When a company form is organized, that company becomes a separate legal entity. Unlike his board of director or an individual who is running that company or the group of individuals who are running that particular company, the company itself is liable to pay certain taxes, and that tax is considered as corporation tax. Last but not the least is property tax. This is also termed as house tax. If a tax is laid on the price of goods or services, then it is called indirect tax, like goods and service tax, which is now replaced earlier, which was in terms of VAT, central excise duty, custom duty, etc. Property or an asset owned by an individual also leads to a tax liability, as the country's land is occupied by individual. So individual or a firm is liable to pay such property or house tax. There are few other taxes like road tax, municipality tax, depending on the amenities provided by the government. This is all for the terminologies for business arithmetic. Thanks for watching.